Thursday, 21st February, you're back in business with me, Harsha Subramaniam. Mandeep Singh Rangar, Chairman of IndusView, joins us today on what he expects from the Finance Minister in this budget. Mandeep, thank you so much for joining us. Let me begin by asking you about your expectations from the fiscal deficit. And the Finance Minister seems extremely confident of reaching his target of 5.3%. What is the sense that you're getting, and how do you think this target can be achieved?
Thank you, and happy to be here. I guess one of the key goals for the Finance Minister is to make sure he doesn't have India lose its credit rating, because that's obviously under fire. And one of the concerns about there is getting this budget deficit over a certain period of time from north of 5% to at least sort of the 3% benchmark, and in the interim about a 4.5% to 5%. Now, what's really required here is, of course, cutting down some of the subsidies, and some of the things like fertilizer subsidies reduction will certainly help. But also at the same time, a key theme of this budget will have to be increasing foreign inflows, because unless you get capital inflows from overseas, you're not going to be able to reduce that current account deficit. So it's going to be a real pragmatic budget, and it should not be a populist budget. This is one where he's going to have to increase the tax base, rein in the subsidies, and increase capital inflows.
If you look at any data points, any parameters at this point, Mandeep, it's very clear that growth is tapering off. What can Chidambaram do to revive growth?
So that's a really good question, because you look at the last budget from a couple of years ago, and you see that one of the big things that they were fighting back then was the inflationary pressures on the Indian economy. And I think one thing that to some degree has been successful via a combination of policy changes and, of course, the Reserve Bank of India interest rate policies have been to get that inflation below. So now with that under, if you may, under wraps, or certainly under control to some degree, the real focus of the budget should be growth. And there again, I would say that it's partly to be measured against numbers and seeing how do you get GDP growth back to, from 5 to 6, 7% where India ought to be. But also looking at measures, not just the numbers. How can you speed up the bureaucracy of decision-making? How do you speed up the whole privatization attempts by the government? And, of course, that's a key part of what will help them reduce the current account deficit, too. Growth is going to be a combination of not only boosting the export model of India, which so far is very domestically oriented, but also, making sure that foreign investors feel very comfortable. And given the visit by the British Prime Minister and the biggest trade delegation this month into India, there's certainly interest in India, but it has to be seen as a safe place with no retroactive tax applications that we've seen in the past, and with an economy that people can predict to some degree, and that's been missing for the past couple of years.
When you talk to investors, Mandeep, and what is the sense that you get? What is it that they want to hear from the Finance Minister this time, and how can the foreign fund flows that we've seen in 2012 sustain in this year as well?
Some of the nervousness in the foreign investors' minds about global growth slowdowns are a bit abated now. People see that maybe the worst is over and there's chance for growth and, again, risk back in the market. And certainly India, along with other BRIC economies, is one of the places where foreign investors will look to for growth prospects. What the Finance Minister really needs to do is to provide a certain measure of certainty. We know that the next election is still over a year away. It's 2014, so there's some time to put some measures into place. We know that with the credit rating of India under scrutiny, India is going to have to make itself to be seen as a safe and predictable haven. And there again, I think some of the issues of the past, whether it's corruption, whether it's retroactive tax application, certain issues involving large multinational corporations such as Cairn or Shell or similar Vodafone, of course, will have to be put in the past. And India has to kind of start with a clean slate. And this Finance Minister's budget is a real opportunity to say, look, the past is the past. Here's where we are. Let's have some more transparency and, more importantly, predictability about tax applications, jurisdictional issues, whether you can have foreign subsidies, have transfer pricing in India or not, which is currently being looked at by India's taxmen, and certainly some degree of tax liberalization, because India today has a corporate tax rate of north of 30% compared with a European average of about 20%, and even across Asia it's less than 25%. So reducing taxes, giving measure of confidence, and providing some more transparency, all of which helps make India ultimately a very attractive place for investments given disparate global growth rates from Western economies and the BRIC economies.
When we talk to corporates, Mandeep, one gets a feeling that the environment is really not conducive for fresh capital investment spending. What do you think the finance minister can do to change that situation?
Well, one of the big tools in his hand is privatization, right? So we know that he's looking at privatization of big industries. Some have already happened in the past few months, in the past couple of years. The oil sector, the gas sector, telecoms, infrastructure, big capital investment in infrastructure, all these lend itself towards inward investment in India. And certainly getting more domestic consumption on the back of a more affluent middle class. And that, of course, means, going back to the tax argument early on, making these things cleaner and making things more harmonized from GST to minimum alternative tax. There's just such a confusion around those issues that I think getting a combination of domestic tax clarity and getting foreign investors to really put big budget investments into India when it comes to taking large public sector companies private and investing in the long-term infrastructure build of India. I think those things are massive capital investment attractions in India, because that's the difference between where India is today and where it kind of ought to be.
Sure. One final question. What is it that you don't want to hear? What do you think are the red flags in this budget?
Well, there's a few things that we don't want to hear from about. One, we don't want him to put any fear factors in the market that get capital markets to shudder. We also want to make sure that he doesn't create a false economy. Look at India's gold imports. India's gold imports have, on paper, gone down in the past year between 2012 and 2011. But the word on the street is that the informal imports, or in other words, illegal imports, now constitute 25% of India's gold imports. So if you find ways that are too on paper clever, they'll just find, the market will find ways to circumvent them. The second thing, of course, is you don't want to put any scary tax situations on foreign company investments into India, because that again will create this mood of apprehension for foreign investors to come into India. And lastly, and not the least, even though I think that it's not a populist budget, I do believe that to some degree, keeping the masses and keeping the flow of financial upliftment going down to the core of India's economy, which is agricultural, is going to be really important, because you don't want to get social unrest by means of over taxation of either the farmers or certainly people who support the middle and lower ends of the economy. So those are a few things that I think the finance minister to watch out for. Don't scare away the foreign investors, don't scare away the farmers, and don't create false economies of taxation that ultimately get circumvented.
Well, I'll leave it there. Mandeep Singh Rangar, many thanks for joining us with your perspective. That was Mandeep Singh Rangar from IndusView in London. Up next, Joyce Chang of JP Morgan Chase on why she thinks Asia is the place to be among emerging markets. Back in business, 2 minutes. You're back in business with me, Harsha Subramaniam. The emerging markets demand story is holding up reasonably well, and Asia will be the driver for emerging markets growth this year. That's the view coming in from Joyce Chang of JP Morgan Chase. My colleagues at Bloomberg in New York caught up with Joyce for this exclusive chat.
I think that what we see is that the demand story is actually holding up reasonably well. And I think that, once again, Asia is going to be more of the driver for the emerging markets economies this year. China and India were weaker at this point last year, and we see them coming back pretty strongly.
Well, Dom. Well, I was going to say, because if you talk about emerging markets, they're not all created equal. I mean, you have Latin America, you have places in Asia. If you look at what we talked about earlier about the U.S. versus emerging markets, just look at the ETFs that track them. From a very passive basis, these are index-based investments. The S&P has totally outgunned the emerging markets ETF, and that's the real kicker here, because if you look at the way the S&P has performed overall, that's the big deal. That's a 12% outperformance of emerging markets underperforming the S&P 500. But it's not all about index investing, right? You have to pick stocks, and that's where you can add value, because according to Morningstar, they're outperforming. Active stock managers are.
The other thing I'd add to that, though, is if you were saying, okay, there could be rough roads ahead for the U.S., which is your point, you've taken that outlook down based on the fear of the sequester, then aren't emerging markets going to feel the pain? In other words, aren't they usually the ones that feel the pinch? Because, yes,
Joyce,
they've got lots of commodities, they've got lots of that, but at the end of the day, they rely on us still.
Joyce, you want to take a stab at that?
Well, emerging markets this year are actually 73% of the contribution to global growth. So I would say they become less reliant on the U.S. and the developed country outlook, and it's been more about domestic demand within those countries.
So could we be in a situation then where you see the U.S. really tanking, but global markets improving
Staying steady,
significantly?
yeah.
Yeah, I think, and what you've had in emerging markets is actually quite low volatility compared to the developed markets. But I think the growth story will matter going forward. I also think the inflows have looked healthy. Right now, we see that the fundamentals, the flow, the demand for emerging markets still looks to be in a pretty good place.
Well, what's also curious, of course, is, as you have pointed out, our exports, the U.S. exports to emerging markets rising dramatically, even as they're coming down, obviously, to Europe. And maybe you can just talk about the extent to which that flow is going to continue in the future. The blue line, in other words, what we're talking about, where U.S. exports to the BRIC countries rising pretty dramatically.
Yes, what we see is that still that emerging markets, the BRIC share of the global economy continues to grow. Just taking a look at the BRIC countries, they're about 73% of the contribution to global growth this year, and we've seen that the share of exports has continued to perform very well. And in many of these countries, the domestic demand story is looking better than this time last year. So Brazil had a dismal growth year last year. It's looking better this year. China also, all the fears were on a hard landing, and that has stabilized. India, the same thing, had a lot of political turmoil, which has since stabilized. So I think it's not just the global outlook, it's the outlook within emerging markets themselves.
That's a view from Joyce Chang of JP Morgan. Out of time on the show. Thank you so much for joining us in Business Today.